I think you're going to see very strong capital returns. As you know, the banks are overcapitalized, and as we just saw from these results, they all passed with flying colors. So we would expect the range of return of capital as a percentage of our earnings estimates for the next 12 months to range anywhere from 80 to about 130%. Wells should have a very strong number, as well as some of the others. So we expect to see big numbers once again this year, similar to what we saw last year.
Tom, I'll put the same question to you.
I agree with Gerard. I think the average of those 18 banks will be something close to what we saw last year, which is 100% payout of the expected earnings. And that was, combination of dividends and share repurchase.
Tom, the fact that we're now so many years into these stress tests, and obviously the banks are very well capitalized, not a lot of suspense about these particular results. Do you think it's done much of anything to bank management's orientation and how they're running their businesses? In other words, are they more inclined to essentially say, look, we have to show ourselves to be incredibly safe and conservative and really concentrate on just buying back stock in the absence of being able to take other risks? Does that change the value of these businesses?
It's tough to isolate, the one factor. Certainly, the Great Recession changed everybody's approach to risk management and capital and liquidity management, and the regulators played a role in that. But Gerard and I had separate meetings this week with Jamie Dimon, and when we were at the worst point, he said we were going to get back to a golden age of banking again. And I think he told Gerard, as well as he told me, we're in the golden age of banking right now.
So were there no concerns, Tom, when you were talking to him about whether interest rates might get cut or the broader U.S. economic outlook?
Well, my meeting was at 2 o'clock on Wednesday, so he was not concerned at all about whether the Fed was going to cut rates. They didn't anticipate that the Fed would cut rates, but they'll be prepared to deal with whatever environment they have. The industry, as you're talking about right here, the industry is so much stronger, so much better managed, so much more liquidity and capital. It's and at a high level of earnings. It's really a night and day difference from 10 years ago.
Gerard, I get that the industry's in a better place. I mean, it's more well capitalized. You've got, some tighter and more stringent regulations. You have seen some changes, though, coming into the stress test this year. How much will politics play a role as we go into 2020?
When it comes to return of capital, I don't really think politics will play much of a role. In fact, many of the regional banks are telling us they're trying to manage their capital ratios down because they have excess capital. Now, our universal banks are closer to levels that they're comfortable with, but the regionals want to bring it down. So when it comes to politics, however, in this particular area of returning this excess capital, I just don't see it. And as Tom pointed out, these banks are so strong, and similar to my meeting with Jamie Dimon, I would say that he's very confident that these banks, his bank, and the industry will get through any downturn whenever it comes in much better shape, because they know their business is much better and they're better capitalized and there's much more liquidity.
Mr. Dimon obviously putting himself out there this week. Gerard, to round things off, what's your top pick of the big six banks?
I would say from a value standpoint, I would go with Bank America. That is the best way of seeing appreciation. But through the cycle, if somebody wants to own a stock for the next 3 to 5 years, J.P. Morgan would be the one to own.